Have you ever stopped to think if the stock market has a secret emergency brake? Something that can be pulled when the whole thing is just careening off the rails. Well, it does. And we're about to dive into this incredible, invisible system that stands between an orderly market and absolute financial chaos.
So here's what we're going to cover. First, we'll go back in time to the one day that basically forced these brakes to be invented. Then we'll look at how they were built and what the system looks like today. After that, we'll ask the big question: do they even work? We'll see how the US stacks up against the rest of the world. And finally, we'll peek into the future of market safety.
To really get why these systems are so critical, you have to imagine a time before they existed. A time when the market was basically a high-wire act with no safety net.
Just look at this number. This is what scarred an entire generation of traders. On a single day, October 19th, 1987, the market didn't just fall. It completely evaporated, a drop of almost 23% in one day.
But see, this wasn't just a panic. It was a total breakdown of the system. New automated trading strategies basically created this vicious, unstoppable selling spiral. And with zero rules in place to stop the bleeding, the market's fundamental plumbing just broke.
So yeah, this event left regulators with a terrifying question. How in the world do you stop an unrestricted free fall in a modern, super fast electronic market? The answer they came up with was to build that emergency brake. They decided to call it a circuit breaker.
The absolute catastrophe of Black Monday led directly to the invention of these market-wide circuit breakers. Regulators realized they needed a tool to force a timeout, not just on trading, but on human panic itself. Now, the system has changed a lot over the years. The first version was, well, it was pretty clumsy. It was based on a fixed number of points. But think about it. A 250-point drop means way less when the market's at 10,000 than when it's at 2,000, right? So they got smarter and switched to a percentage-based system. And they also started using the S&P 500, which is a much, much better snapshot of the entire market. So what is a market-wide circuit breaker? The best way to think of it is as a mandatory system-wide speed bump. When things start getting really ugly, it literally hits pause on every single stock exchange in the US. The goal is to give everyone a moment to breathe, actually digest what's happening, and hopefully stop a panic from turning into a full-blown meltdown. Okay, here's how today's system works. It's got 3 levels. If the S&P 500 drops 7%, boom, level 1 is triggered. That's a 15-minute trading halt. If the market reopens and keeps tanking to a 13% drop, we hit level 2, another 15-minute halt. But level 3, that's the big one. A 20% drop shuts the entire market down for the rest of the day. Game over, see you tomorrow. But there isn't just one type of break. Besides that market-wide sledgehammer, there's also a more delicate tool, kind of like a surgical scalpel. It's called limit up, limit down, or LULD. Now, this doesn't stop the whole market. Instead, it just puts a quick pause on a single stock if its price goes completely haywire, moving too fast, too fast. This is what prevents those bizarre flash crashes you hear about in one particular company. This all sounds fantastic in theory, right? But it leads us to the most important question of all. Do these emergency brakes actually work? Or could they, and this is the scary part, actually make a crash even worse?
And this is where things get really interesting. Some research points to a potential dark side. The idea is that as the market gets closer and closer to a circuit breaker trigger, traders don't calm down. No, they panic more, selling like crazy to get out before they get trapped by the 15-minute halt. They call it the magnet effect, where the break itself actually sucks the market down faster. And if you want a perfect textbook example of this magnet effect, just look at China in 2016. They rolled out new circuit breakers that were way, way too tight. The market hit the first halt, and traders, knowing the next one would shut everything down for the day, just stampeded for the exit. It was a disaster. The system made the panic worse, and they scrapped it in just 4 days. Now contrast that with the US in March of 2020. The system got triggered 4 times during the COVID crash, but because the thresholds were wider, they acted like a speed bump, not a cliff. The market bent, but it didn't break. So the US system seems to work, more or less. But is it the only way to do things? Not at all. Let's take a quick trip around the world to see how other major markets handle a full-blown crisis. It's really interesting. While the US prefers that market-wide sledgehammer approach, just halt everything, European exchanges are much more surgical. They don't stop the whole market. Instead, they just pause the one stock that's going wild and hold a quick auction to try and find a stable price. It's a totally different philosophy for managing panic.
But here's the thing. These systems can't just be set in stone. They have to evolve. I mean, what happens when you throw super volatile new things like crypto or the insane speed of artificial intelligence into the mix? And that evolution is happening right now. Regulators are figuring out how to bring crypto products under the same safety umbrella as stocks. They're also standardizing rules across different exchanges to close loopholes. But maybe the coolest development is predictive tech. Get this. Researchers are using AI that can spot the pattern of a crash with incredible accuracy, potentially giving us a heads up before a crisis really kicks off. So what does all of this actually mean for you, the individual investor? Well, during a halt, the big guys are hedging in other markets, and the trading firms are widening their prices to protect themselves. For you, the biggest risk is getting a truly terrible price when the market reopens. And this brings us to the single most important takeaway from all of this. In times of chaos, do not use a market order. Ever. Always use a limit order. That lets you set the exact price you are willing to buy or sell at. It's your best line of defense. All of which leaves us with one last big question. You know, these circuit breakers were designed to give slow-moving humans time to stop, think, and process. But in today's world of high-speed algorithms and instant information, is a 15-minute timeout still the right tool for the job, or is it becoming an analog solution for a very digital problem? That's the core tension regulators are going to have to deal with for years to come.